Welcome to Theo Trade. This is Don Kaufman. Here we are. It's August 16th, 2017, doing the Theo Night video. Well, we had FOMC minutes out during the trading session today. Saw a extremely small bout of volatility following that, but largely speaking, the markets were massively unchanged. S&P's up 3, the NASDAQ futures up about 8. And specifically with the S&P futures, we're back into much lighter volume than we've seen, again, in quite a number of previous trading sessions. With that, we're going to get right to a trade idea in this Theo video. So I look quite frequently at the Dow Jones Transport Average. One of the primary reasons I look at this, and first and foremost, if you're not familiar with the Dow Jones Transport, average, it's just an index, but it's not even a tradable product. And a lot of people look at it and go, what do you mean you can't trade it? When you click on it, it's not a tradable product, right? So if you looked at the Dow itself, yes, there's the diamonds. There are ETFs that correspond to this. Come to those in just a minute, but the Dow Jones Transport Average, and I look at it quite frequently because I was I was raised around traders, and I still talk to on a day-to-day basis a lot of these older school traders, and they're always talking about the Dow Jones Transport. So I have been looking at the transports, and it appears, well, first of all, the transports had a wild slide to the downside in really the last month of trade. This kind of appears to be much more of a bearish bounce to the upside. Today could be a bit of a key reversal in there. Now, if I take a look at this on a percentage year to date, just to show you how large this recent slide was, again, kind of measuring it from right up here when it was up about 8.6% year to date. All right, we slipped all the way down to almost unchanged. We just rallied up 3-4%. So I believe this is a decent place to come in and short it. So why not use this? It's not a tradable product. So you can look at what's called like IYT, and IYT is the iShares Transportation Average. It's an ETF. The problem with the ETF, you start opening it up, and if you look at things like volume and open interest, it's just not a tradable product. And it's okay to say that. Like, you look at the bid offer spreads and you're like, I want nothing to do with this. There's no volume in here. They don't even have weeklies. So I like to point that out once in a while. Hey, that's a product that I wouldn't trade. Instead, I've been looking at the relationship between the transports and FedEx. Okay, and FedEx is very, very similar in respect to the fact that, again, year to date, this thing was up, and this is FedEx, they like reinvent the world over here, but they were up 17% year to date, sold off, okay, quite a lot. I mean, they sold off, 8-9%, and here's been the exact same bounce. And you'll kind of notice I'm kind of keying into today's kind of reversal of trend over here. So again, I'm not so much the market technician. I don't necessarily look for these big reversals, but this undoubtedly to me looks like that bearish bounce that's likely to be sold into. So on FedEx, what kind of trade opportunities do I look for? Most of the time when I address and I'm looking for a trade, I start here on the trade tab. And the reason I start here on the trade tab is I'm always looking, okay, first of all, at the different expirations. Secondly, I'm looking ultimately at the implied volatilities. And one thing that really stands out to me in implied volatility here, if you take a look at right here, the September's, okay, 15th versus the September 22nd, there's a big differential of that implied volatility, okay? Because there's a big differential of implied volatility between these, I succumb to the idea that there's probably an earnings announcement. So you go to the chart, sure enough, on what? Earnings on 9/19 after the market. So go back over here and I take a look and I go, well, this expiration September 22nd, I don't want anything to ultimately do with that. So then you open up the September expiration, the September 15th, okay? And I'm just taking you through some of the thought process of this trade. You start to set up for a trade, but then you've got another issue in here, okay? This is a $200 and roughly $10 product. All of a sudden, when it gets over $200, starts jumping in $10 strikes. oh, I don't want to deal with that because then I'm going to have a lot more capital tied up than I ever intended to. So I close up the 30-day options. I open up the 23-day options. Although this is short in terms of time, right? 23 days between now and 23 days. Yeah, but the expected move for that period of time is almost $7. So my thought process in this is if I want to get short, I can do it right here. I can do it right here. There's not monstrous amounts of volume, but there's more than enough to get it done. And the bid offer spreads in here, they're not as formidable as you may believe. So this is a $5 wide spread. So it's buying the 212.50s, selling the 207.50s, buying the 212.50s, selling the 207.50s, and should be able to execute that trade right around $2.50. One of the key points to be made when liquidity is not necessarily phenomenal in a product, using spreads will protect you in the bid offer spread, meaning the bid offer spread is going to be much easier to deal with. Okay. This is just for 23 days, and we're going to come over here. We're going to analyze this particular trade. Okay. And it's a straightforward, I'm getting bearish. It's for the next, again, 23 days to expiration. It's just a bearish in-out spread. I'm trying to make approximately between 55 and 65% on this trade here in FedEx. All we'd really need ultimately is one nice sell-off. We have about almost a $7 expected move. So all of those parameters could easily play out in a very, very short period of time. Thanks everybody for joining us here at Theo Trade. Have a wonderful evening. Bye-bye.